Great. I think it is 11 o'clock, so we should probably get going. Um, so the main event this week is talking to a panel of private equity managers. So we've got three from CT Private Equity, from Oakley Capital Investments, and from Patria Private Equity. So the idea of this is really to give you more of an insight into how these funds work and what these managers are doing. So if you've got any questions at all about how private equity works, please do put these into the chat box in the YouTube um, chat box function. So before we get there, as usual, we've got some news. It being the bank holiday week, really, there's really very little going on. So I'll probably rattle through this quite quickly. But two things I did pull out. First of them is Octopus Renewables Infrastructure. Very familiar chart that we've seen in all of these renewable funds, where everything seems to be going okay until interest rates start going up in 2022, and then the share price falls off quite quickly. And then we've seen this steady attrition of the NAV that we talked about last week, which is a lot that's due to power prices. More recently, the discount has stabilized a bit, but the yield is still very high and the discount is still too wide. And this is obviously part of what we're talking about today. So the main thing that they've done this week is announced a fee cut. So this is, again, is not unusual. Other funds in the sector have done this already. So they're moving from a situation where the fees are based solely on NAV to basing them on a mix of NAV and market cap, about half and half in this case. Just 1 second. There we go. There's one of our guests coming in a second. The way that they structured this, one thing we pointed out very early when people did this was they would, if you went back to a premium, then you end up paying more. And obviously that's not really the intention of the thing. So this is definitely stated it's capped at NAV. So it doesn't kick in until November, but when it does, if nothing else changed, they currently save about £700,000 a year on the management fees, which obviously goes into the pot that's available for dividends, which is all good news. And they're also trying to narrow the discount using buybacks. So they've bought back over 5% of the company so far. The share price is about 70p, so that we're not getting towards the £30 million share buyback total yet. I think when we do that, we could see them sell something else, extend that buyback program. I don't think we would be done at that point. Warehouse REIT is, it's one of these ones that's being bid for, and that's why the share price goes rocketing up there. And it's been a sort of a bit of a tussle between Tritax and Blackstone, and Tritax said on Friday last week, we didn't pick it up for the show, but because I think it happened afterwards, but they said they wouldn't put up their offer anymore. So the takeover panel were going to organise an auction between the two, and they cancelled that. And then by the end of the day, Blackstone was saying, we've got over 30% of Warehouse REIT now signed up for this, for our 113.4p a share bid. And that means it's now mandatory. So when it's mandatory, it doesn't mean you have to sell. That means they have to make the bid because they've got over 30%. Tritax formally terminated his offer on the 27th of August, and now the Blackstone bidding vehicle has gone up to 35.6%. We talked about this similar situation with Primary Healthcare Properties and Assura. So this offer stays open now. It's open until 1 o'clock on the 10th of September. If nobody else accepts the offer, then it just stays with them being a big shareholder, and they won't be able to increase that without making another bid, but that's very unlikely. If they get through 75%, then they will delist it. So you'd end up being a minority investor in an unlisted company, which is probably not what you want to do. And when they get to 90%, they'd probably be able to do the compulsory purchase. That means they end up owning 100. There was supposed to be an AGM next week on Tuesday. That's now being delayed to the end of the month to give Blackstone really time to get all this done. So it does look like it's going to disappear, unfortunately. We were hoping that Tritex would win and those assets would still be available for you to invest in, but that doesn't look like it's going to be the case. So that's all from me. I'm now going to bring in my panel. If I just stop sharing, and I'll let Iman behind the scenes bring them onto the screen. There we go. There's Alan.
Hi, James.
And Andrew.
Good morning.
Steve. Now, Alan, there's a little bit of a noise coming from you, so if you don't mind, until you're talking, do you mind muting yourself? Is that all right? I'll let you do it rather than Iman doing it, because otherwise we'll get into a situation where you want to speak and she's not listening to you. We don't have to do that. But I was going to ask each of you in turn just to introduce yourselves briefly. Just give us 5 minutes on who you are and what fund it is that you're running and the attractions of it, please. And maybe we start with Andrew, please.
Great. Good morning, everyone. So my name's Andrew Carnworth. I'm a director in the team at Columbia Threadneedle and the deputy manager of CT Private Equity Trust. So I originally trained as a chartered accountant before moving into private equity back in 2008. And since then I've worked on both sides of the industry as both a GP and an LP. And I've been with the team here for just coming up to 12 years. So Columbia Threadneedle Investments itself is a global asset management firm. We've got about 600 billion under management. It's part of Ameriprise, which is a Fortune 500 company listed on the New York Stock Exchange. CT Private Equity Trust itself launched back in 1999. So we recently celebrated our 25th anniversary. And since then, it's been continuously managed by the same team led by Hamish Mayer. The trust is listed on the main market of the London Stock Exchange and provides investors of all types access to private equity and the strong returns available through the asset class. It aims to democratize private equity, making it easy for investors to access a diversified portfolio of private companies. The trust targets an even split, roughly even split between fund investments and direct investments into single companies. And we invest in high quality, small and mid-sized companies at attractive valuations. Those investments are sourced through our large and well-established network of expert private equity managers. Together through the funds and the direct investments, which we often refer to as co-investments, it provides a portfolio of about 500 companies with about 50 lead managers. And that's split roughly 40% UK, 40% Europe, and 20% in the US. Over the last 25 plus years, the trust has significantly outperformed public markets, and it also pays a consistent and growing quarterly dividend, the yield of which is currently about 5.9%.
Brilliant, thank you very much. Stephen.
Hi, morning. Stephen Tredgett, partner at Oakley Capital. I have been for about 8 years. My background, which I'll talk very briefly on, was actually advising public companies for a good 15, 20 years. And then when I was increasingly finding it was harder and harder to find good quality growth companies to bring to the stock market. And the reason being is they were being poached by PE. And so in 2016, I resolved to kind of leave public equity to join private equity. The investment company that I'll be talking on behalf of this morning is Oakley Capital Investments. I'll refer to it as OCI. It's a London listed investment company, and it provides investors with access to investments in high performing European private companies. There's 33 of them. Even in a kind of more modest years, they've grown at about 15%. EBITDA growth organically 21-22%, including acquisition. And how do you get access to those companies? Well, how does OCI? It does that by investing in the funds advised by PE manager Oakley Capital. So it is a direct PE vehicle as opposed to a single manager, in contrast to, let's say, a fund of funds. And is it working? Yes, it is. I mean, it's delivering. It's not an income play, it's a capital growth play, and it's delivered shareholder return over the last 10 years, just over 300%. Or if we want to just look more recently, year to date, the shares are up about 13%. So very briefly, who are then Oakley Capital? In short, we are headquartered here in London. We're one of the leading European buyout private equity firms. And we've made a name for ourselves for partnering with successful founders. And these are founders of mid-sized, fast-growing, tech-enabled businesses. And we've done that in 4 sectors: technology, education, digital consumer, and business services. The advantages of working with founders are they're going to remain invested, so we're aligned with them. We are often the first institutional investor into these businesses. We're going to help them go on that operational maturity curve, which they haven't started on. They're being successful, they're growing, they're profitable, but now they need to prepare themselves potentially for kind of bigger PE owners who we naturally sell on to.
Brilliant, thank you very much. And lastly, Annan.
Yeah, hopefully this sounds okay, James. I'm Alan Gauld. I am the lead manager of Patria Private Equity Trust, or PPET for short, and I've been the lead manager for the last 6 years. About 16 years in private equity, making investments in private equity funds, both on a primary and a secondary basis, and also direct investments as well. So turning to PPET, PPET is on the FTSE 250, was launched in 2001, so it's over 2 decades old. It used to be known as Standard Life Private Equity, Aberdeen Private Equity Opportunities Trust, but when the manager moved over to Patria around 18 months ago, we changed the name to Patria Private Equity Trust. And PPET, since its inception, has been about partnering with around 15 core private equity manager relationships through their funds, which we did for 18 years exclusively, but also more recently directly alongside them into private companies. This trust is European focused. It's about 3/4 in European headquartered businesses and European headquartered PE managers. But importantly, it's mid-market focused. That's a key element of our strategy here. So we define the mid-market as businesses of between 100 million euros and €1 billion at entry. These are growing, these are profitable businesses, and importantly, cash generative businesses. And they're businesses where they're often founder-led businesses where a private equity manager can come in and really help those businesses take the next step, grow even faster, and eventually exit to a larger PE firm, to a trade buyer, or even IPO. But there's that exit optionality in the mid-market that perhaps there isn't in the larger end of the market. PPET also pays a dividend like CTP does, yields around 3%, paid quarterly, it's grown every year for the past 10 years. And PPET has delivered for its shareholders since inception, last 10 years. If we look at the NAV total return for PPET since inception in 2001, it's around 11% annualized. Over the last 10 years, around 14% annualized. So from a returns perspective, a capital growth perspective, it's delivered as well. So that's PPET.
Brilliant, thank you very much. And you've touched on it a bit there, Alan, but I just wanted to ask all three of you. So there are lots of different types of private equity, ranging all the way from venture capital, where people are starting businesses off, to growth, where they may be looking for money for the first time, through to the buyouts and the mega cap buyouts. So which bits of the market do your funds concentrate on? Maybe Andrew, if you go first, please.
Yeah, sure. So we're probably in the middle. Our real focus and the great majority of our investment is in lower mid-market buyouts. So what I mean by that is businesses up to 500 million of valuation at entry. So established, profitable companies, but they're still small and medium sized. Because they're established and profitable, this is much lower risk area than, for example, venture capital. Our focus is on the lower mid-market because we think there's a huge number of very dynamic entrepreneurial companies to invest in. but the market is much less competitive and less intermediated. And that means it's possible for sector and regional specialists to find and originate off-market deals where they're convincing management to partner with them to grow the business. We're often investing in founder-owned or family-owned businesses that are looking for help to accelerate their growth, either through geographic expansion or, for example, market consolidation. And we're often the first institutional investor in those companies, and then we will typically exit either to other financial investors or to trade players. Another quite important attraction, I think, of the lower mid-market is typically the use of leverage is very modest, and the returns are really driven by growth in earnings versus financial engineering.
Stephen, I think you're going to say some of the same things.
Yeah, I am. God damn it, Andrew. So yeah, I'm going to say everything he said. But I will say that there's a bigger range. So we might go down a bit lower and might go up a bit higher. So you might see us in EVs from a few hundred to a couple of billion. The size, and then we have different strategies and different teams focused on those sizes. However, really size doesn't matter. I think, a lot of those characteristics Andrew said are the important characteristics. And if they come, if it's founder owned, high growth, disruptive digital businesses in the sectors that we focus on throughout Europe, then we're happy to invest in those and have the firepower to invest in them, whether they are a few £100 million business or a £2 billion pound business. And again, it's that founder element's important to us. Why is it important? Well, you're very much aligned with them. So yes, you're taking a controlling stake, but they have to retain that level of skin in the game that this matters to them. And that's also why what Andrew and I are describing is quite difficult to do. Because if you are the first institutional investor into a founder-led businesses, this is their baby. They've created it. And we all know what the wider public and media think private equity is about. It's kind of like dark, sinister beast that's going to rip out the heart of your business. And so, which I'm sure we're going to discuss, is not what private equity is. But to gain the trust and for a founder to allow institutional capital in for the first time, is a reputation that you have to achieve over a long period of time. And when you get in, there's a heap of opportunity to help mature those businesses and potentially sell them onto a different type of PE.
Great, thank you. And then Anna, you already said mid-market is your baby too. What part of the world, could you just remind us again where you're looking?
Yeah, there's not much left for me to say after the two gentlemen have already explained the mid-market, and our strategy is very similar. Mm-hmm. As I said at the outset, I think in the mid-market you're buying those profitable businesses with the potential for further growth. You're typically buying them cheaper than the larger cap space, with less leverage, more low-hanging fruit from a value creation perspective, and more exit optionality when it comes time to sell. So what's not to like? We don't have any exposure to venture capital. I think that's a completely legitimate strategy, but it's not ever what we've done. I think doing direct investments in venture is a very different game than in the buyout space. We'd have around 5%, give or take, of the portfolio in what would be described as growth equity, so businesses that are established, probably around cash break even. The vast majority of what we do is buyout, and a lot of that is partnering, as Stephen sort of alluded to, with families and founders, and being that first institutional capital to come in and help that company take the next step.
And what makes a good investment for private equity? What sort of company? Can you keep going?
I can, and sort of alluded to it there. I always think if you're undertaking a primary transaction, as it's called, a sort of buying from a founder or a family, there is that inherent opportunity because founder is often quite skilled in the product or the service, and quite a lot of that knowledge is often with the founder or the founders. Quite a lot's in their head or on their phone, So that opportunity to take that business, transition to a more a broader management team, professionalize, there's a lot of low-hanging fruit in that. But it can also be like helping those business internationalize. It can help expand the product or service set. It can be helping them undertake buy and build. They're seeing their local competition undertaking inorganic growth. They want to do the same. They don't really know where to start, how to build that M&A team at the company level. So those are the sorts of opportunities. And it might be something quite niche. It might be a software business that's wanting to undertake a transition to the cloud from perpetual license, sort of having a private equity partner that can then help sort of advise them and put them in contact with the right resources and help accelerate that's the opportunity. I mean, there are good secondary transactions along the way as well, and Stephen alluded to some of the misconception around private equity and this idea of passing the parcel, passing a company around different private equity firms. But I actually think quite often in the ecosystem, different private equity firms can play different roles. So a small private equity firm can help that founder transition, but then it might sell to a larger firm that's a software specialist, or if it's in that space, or a sector specialist, shall we say, that can take the company to the next level. So secondary buyouts often get a bad name, but we see a number of really good secondary transactions. But really that key one to me is that founder transition, buying from families and founders and professionalising the business further.
Cool, thank you. And Stephen, how long do you think you want to for when you buy it? When you first looking at something, do you look at it and think, well, we can flip that in 3 years, or is it much longer term time horizon?
Our investment thesis is typically based on our ability to achieve a 2 times net return and achieving that over a 3 to 4 year period. And there's a couple of reasons why you have that time scale. The first being, if you look much beyond 3 to 4 years, your ability to forecast outcomes diminishes quite significantly. So for a base case return, we might think that there is significant returns beyond that, and we also will have an upside case that will be way beyond 2 times. And bear in mind, 90% of our investments at least meet or better that, more than that, 95% of our investments meet or better that 2 times realised return. I think the realised return to date is about 4 times on the companies we invested in. But as I say, 3 to 4, and it also matches, kind of fund life. Typically you're looking to, funds last 10 years, but in truth, you're not looking to kind of wait until for 10 years before you sell an investment. You're looking to broadly make investments over a kind of 2 to 5 year period, and then harvest them, kind of over the next 2 to 5 years. So our average hold period is late 3.7 years. Now, as Alan alluded to, if you've got a great business and it's performing incredibly well, but it's time for a fund to sell for a range of possible reasons, and we'll always bring in another investor at that point, it may be that it makes perfect sense for a new vintage of funds to make an investment. And often we've gone on to make minority investments in the companies we've backed and gone another 4 years. There's one investment, Facile, a price comparison website in Italy, which has been across 3 funds, has grown its EBITDA 25% every year for every year that we've known it, with a simple premise. It's price comparison in Italy. It's a very low penetration of that solution in Italy, where e-commerce penetration is very low, and that steady adoption of a very reliable and widely used European solution for insurance, mortgages, telecoms is slowly penetrating, kind of Italy, and it will continue to do so, and has years more growth. So we're not against holding on to a company in other funds for longer than that period.
Great, thank you. Andrew, when you're looking to buy a company, firstly, how do you find them? And then secondly, when the deals are being done, because everybody thinks private equity and debt are kind of synonymous, how much debt do you put in at the beginning, and how much debt are you comfortable with holding?
Yeah. So the deals are sourced by our investment partners, and we invest with over 100 managers. So they're sourcing these deals, and typically they're getting to know companies, courting them, and creating a deal over a number of months or even years. So that's how we source them. In terms of debt, our use of debt in the lower mid-market is quite moderate, as I said. So typically in a buyout, there might be sort of 3 to 4 times EBITDA in the deal of debt at the beginning, and then that reduces over time. So if you look at CT Private Equity Trust, currently our portfolio, the overall debt to EBITDA is 2.7 times. So it's quite modest. And then just, if I may add quickly to what kind of companies that we're looking at, I absolutely agree with everything Alan said, but there are a few specific things that we always look for, which is an attractive market. We're often, as Alan said, investing in kind of niche market leaders, a differentiated product. It's key to have entrepreneurial management. Often that's strengthened over time, but management to us is absolutely key. Strong financials, and I think this is really relevant at the moment. We're always looking for strong growth and high EBITDA margins and strong cash flow conversion. And I think those EBITDA margins, they've always been important, but I think in today's uncertain environment, that's more important than ever. An experienced private equity lead, attractive valuations, and then the key, and Stephen's mentioned this, alignment of interest. For me, private equity only works when there's real alignment between the investors, the management, and everyone else.
Great, thank you. Now, Stephen's already mentioned about some of the returns he's been getting, so more than 2, sometimes 4. The amounts of money, or actually more often than 4, you're saying, at times, the amount of money you invested, which is great. But one of the questions, again, that people constantly ask me about is how you value things while you hold them, and why it is that you get these big jumps up in the valuations when you sell stuff. So maybe, Alan, can you just talk a bit about valuations and how they work?
Yeah, so first thing is, look, the vast majority of our investments, as I alluded to earlier, are cash flow positive. So they're valued on EBITDA, they're valued on earnings, they're valued quarterly, and by basically creating a valuation multiple that is derived from a mix of listed comparables and transaction comparables. That's typically what happens in our portfolio. And there is really strong governance. This is the thing that frustrates me when I see these headlines about private equity valuations. There are really strong governance, certainly the managers we partner with, around valuations. So we're obviously partnering with third-party managers, much like Andrew and CTPE. So they value their portfolio companies on a quarterly basis. They are audited once a year. They are scrutinized by their own investors, which we're one of them. The valuations come to us. We, as a manager, Patria, scrutinize those valuations. We then present the valuations with detailed underlying scrutiny for our top 35 businesses to our audit committee, to PPET's audit committee, who challenge. So, and then we're audited once a year as well on top of that. So there's a double audit there. So, so yeah, I think there's a hell of a lot of governance, which you don't see that attracting many headlines. I mean, look, PE is relatively liquid. So I always think it's like valuing a house. Ultimately, you can look at what the house down the road was sold for 6 months prior, but it's what someone is willing to pay at that time. And I think there isn't much incentive for a PE firm to overvalue, frankly. And so they're always going to be slightly, whether that's consciously or subconsciously, on the conservative side of things. Now, many used to use as standard illiquidity discount when valuing. So you take your basket of listed comps and then you apply like just a 10% or a 20% discount for the liquidity of the underlying company. That's less prevalent now, but I still think there's the inherent conservatism. As I say, there's little to be gained by overvaluing. Fees are charged on commitments, not on NAV. And the industry has frankly become used to exiting at an uplift. Now, the question to me is whether these uplifts will be as large now as they have been in the last 10 years. In 2021, for example, our average uplift upon exit when compared to the valuation 2 quarters prior was just close to 40%. Over the last 10 years, it's been around 25%. We look at the last 3 years, it's been around about 20%. So would it surprise me if that uplift sort of moderates a little bit? No, I don't think so. But I still think we'll see that uplift upon exit as we move forward.
And Stephen, maybe you could talk about how do you get exits done? I mean, when you decide something's looking mature, how do you go about selling it? I mean, obviously, again, people worry about there's no IPOs, there's no exit route for PE, but that's not the way you sell most things, is it?
No, absolutely. And sorry, Alan's answer was excellent to that last question. And there's one point that we should clarify. Why there is no incentive to overstate value is you're not rewarded on it. You only get a performance fee on realization. So there is no benefit, unlike in public equity, where you may get incentivized on your performance in any given year. Until you sell a business, there is no performance fee. And I think that's important. And the house example is a brilliant one. You only really know the value of your house when you buy it, because that's what you're willing to pay for it, and when you sell it. And in between, you are speculating what that might be worth, or the market you're about to go into, which then leads to your question around exits. I mean, in strong markets, and we've experienced those, for the last few years, and particularly the kind of businesses that the three of us are describing, often you're approached. Our portfolios are portfolios of companies where the bigger PE firms that want to come into the mid-market space, or the larger mid-market space, to gain more growth, particularly in a higher interest rate environment, they make themselves very familiar with portfolios like ours. And there'll be companies which they'll be engaging with us all the time on, familiarising themselves, doing that kind of desktop early due diligence to make themselves prepared for and potentially preemptively bid for the companies. And I would say 75-80% of our businesses, there is a preemptive offer by a PE firm. And that then starts a process. They're looking to get that kind of early march on their competitors. They're looking to get a bilateral discussion going with us and the founder that we've backed, and they kind of move preemptively in that. Now, in a tougher market, maybe where kind of there's less liquidity, deals are being done, there's less kind of agreement on price, then you have a target return. You have a kind of, we've discussed already, there is a limit to how long we can hold the business for, and we'll start to plan a year or two out as to how we prepare the business for exit, ensuring that we've kind of completed the value creation that will take place over a kind of 2 to 3 year period. And then you're starting to kind of get the reporting function, gather the intelligence, the data, the commercial evidence that we need to be able to provide other buyers. You appoint an advisor to help, kind of advertise that you're going to sell the asset, and then you start engaging with initially a wide range of potential buyers, and then you narrow them down to those that you think are the most serious and those that you think are the most suited to kind of owning the business. And then eventually that gets narrowed down to 1 or 2, and one's given exclusivity to go ahead and kind of to do the final work to agree the initial offer that they've made for the business. And as you can imagine, you can see why, that process and the underlying market and how it is at that particular time is going to have such an influence on the company and the price you sell it at. Last year, our average premium when we sell to book value is 35%. 3 years ago, we sold a business at 86% premium to where we had IU, one of our bigger holdings. Last year, we sold 3 businesses at NAV. And why? Because yes, there was a buyer, but it was a strategic buyer. It became clear to them very early on that there wasn't other participants in the auction. There isn't that pricing tension, and the price naturally gravitates to NAV. This year we had a strategic battle for a particularly exciting business in the legal tech space, Vlex, that was bought for 300%, 3 times the value we were holding it at. And that's we'll go out there to find the business, but the business itself and the market at that time will be the determining factors on the kind of price that's achieved.
Great, thank you. Andrew, the sticky question, fees, that Steve mentioned a bit about there. But I mean, again, it's one of the things that people moan about private equity. Oh, it's very expensive. Can you just talk us a little bit through how the fee structures work and how they're justified, please?
Yeah, sure. I mean, for the trust, we charge a management fee, and then we charge a performance fee, and that's based on achieving an IRR of 8% over a 3-year period. And there's a high watermark there, so that you can't, that protects investors very well. I think as a whole, fees in private equity are well justified. It is a very intensive industry. If you're doing it right, it is all about partnering. It's about adding significant value, not just capital, to these businesses and accelerating the growth of them. And I think ultimately it is the net performance that it should be key to investors. But I think, going back to the earlier points, it's all about alignment of interest within the industry. As Stephen mentioned, you only get carried interest when companies are sold and you've realized that you've returned money to investors plus a profit. And I think that's a great system and works really well.
Brilliant, thank you. Right, we should get some specific questions from the audience now, and that means we're going to jump around a bit more, but hopefully it will be helpful. First one I've got here is actually just Stephen. Are there any particular trends in private equity at the moment that investors should be paying attention to?
No. Well, private equity has a tendency, because of you've had a brain drain out of public equity. You're very innovative and entrepreneurial in PE, and so they will adapt very quickly to the environment they find themselves in. And you'll see kind of new vehicles and approaches to kind of access to capital, etc. So what I see as a kind of key, one is private equity has really identified that private individuals are looking for greater ways to access private equity. And so, you look at the leading, like Blackstone will tell you that they expect over half of their AUM to be directly from private individuals within the next kind of 5 years. And that trend is being kind of seen, that people are now either starting wealth managers, creating vehicles to attract it. I mean, it's one of the reasons we feel so strongly about retaining a publicly listed vehicle. And Andrew said it right up front. I think this exists to democratize kind of PE. Oakley doesn't need OCI for its capital. It's got 16 billion of assets under management. We generally think having a permanent capital vehicle that private individuals can access is key. But there are lots of other vehicles now that are emerging, and ways in which evergreen semi-liquids that people are using. So that drive to connect PE direct to the private individual is a significant trend. The other trend is PE managers looking to hold on to their best assets in single asset continuation vehicles. So it's this idea that you have a jewel, the market is not going to recognize the value for that jewel potentially, or it's such a great asset, there is clearly another 5-10 years of kind of growth, high growth in this business, and frankly the founder doesn't want to go anywhere, you don't want to go anywhere, it's possibly too big now for your next vintage fund, and so you create a kind of CV for it. And that, one of the things that's enabling that is there is an incredible amount of liquidity coming into the secondary markets. So secondary markets are the buying and selling of existing fund positions or assets within funds, as opposed to primary, which is saying, here's a fund, would you like to commit some capital for it? The fund hasn't invested anything at this point. And there's a lot of inflows. I don't know if any of the guys know the stats for like how much is coming to secondary markets, but that is meaning there's a lot of appetite for secondary funds, secondary asset continuation vehicles being backed by those secondary players. In terms of where we're investing, I would find it hard to I don't think there's been any big switch or drive away. The only thing that happens in really dislocated markets is the opportunity for buy and build really accelerates, because smaller companies, smaller businesses, they don't have access to any other capital. Like the bank, you've got high interest rate costs, less banking liquidity. There's certainly no IPO market, certainly not for growth small businesses, and so they're hamstrung. And that's where if you've got a platform deal that can provide liquidity to do buy and build, then this is a market where you can really flourish in that kind of environment.
Actually, question maybe for you. Steve mentioned about secondary transactions, and that's something I know you did a little bit of in the past. When stuff is changing hands in the secondary market in private equity, this is people buying and selling the limited partnership interests. Does that actually have an impact on the NAV calculation? Is that something you kind of factor into it?
Yeah, so I mean, look, it's worth sort of bringing out the secondary market has grown enormously over the last 15 years. So if you're looking before the global financial crisis, probably about $15 billion was traded on the secondary market. Then, if you look at last year, I think it was about 150, give or take. So it's 10x what it was. And people are just trying to find different ways to exploit that market. The traditional way is the so-called LP-led secondary. So an investor in a private equity fund would take this fund to market, usually appoint an intermediary to go in and sort of generate interest, and you would sell that to another investor in a secondary, and it's usually at a sort of modest discount to NAV. That's typically where things have traded. So we're looking at the market right now, sort of discount, the average discount for a buyout position is probably around 10%. And that's the real head scratcher with private equity listed trusts. Like, they're trading at 20, 30% discounts, but the secondary market is trading at 10. So there's a dislocation there. We've participated on both sides, buy and sell. I mean, we actively manage our portfolio. So last year we sold a portfolio of 180 million of non-core fund positions in the secondary market at a 5% discount to NAV, and that allows us more firepower for new investments. It allowed us to accelerate kind of our move more towards the lower end of the mid-market. So there's a lot of advantages to that. But we'll also buy as well. We see an opportunity in a fund alongside one of our core managers. We'll participate on that side. Typically what happens to your question is that, if you're buying at a discount, you will wait until the next reported valuation comes through and you will market at that valuation. So there is an element of unwinding of the discount, and I know that some people find that a topic of debate. On one side, secondaries are trading at a discount, but on the other side, as we've discussed earlier, the average uplift upon exit is around that sort of 20-30% mark. So what is the right number? And to Stephen's point around semi-liquids, that's why actually you're seeing a lot of good early performance from semi-liquids, because they are buying secondaries right now and they are unwinding that discount vis-a-vis private equity trusts. So I don't know if that answers your question, James, but
yeah, no, that does. I think that's very helpful. And maybe Andrew, you could expand a bit on why you think. Well, I think it's very hard to work out why the discounts on private equity trusts are as wide as they are. I've never really understood it, especially when you get this uplift on NAV exit and you've got the secondary market and everything else. But have you got any insight as to why you think the discounts are where they are and how they might narrow, please?
Yeah, no, I mean, it's a constant frustration. I don't fully understand them myself, but I think it is partly a factor of the market is somewhat risk off at the moment. Private equity is seen as a risky asset class. I think we mitigate that well through diversification, but it is still, there is still risk. So I think when the market comes a bit more risk on, it will come in. I think the other thing is there has been a slowdown in realizations. I think the market is keen to see that pick up again, and when that activity comes through, that will reduce the discounts. And that all comes down to confidence. It's business confidence, it's investor confidence. At the moment, we've been through such uncertain times. We need that confidence to just recover a bit, and activity will pick up. And there are encouraging early signs that is coming through. I think those are the key points, really. And I guess sort of finally, interest rates. People have other places to put their money at the moment, and as interest rates come down, reinvesting in private equity and listed investment trusts will become increasingly attractive versus holding it in cash or similar assets.
One of the things that we did have for a time was this sort of complexity thing, where some of the platforms were saying you can't buy private equity, it's too complicated. I know, Alan, you had that problem with Patria, I think, didn't you? Is that true? I think one of the questions asking about it.
Well, I think this is more to do with the cost disclosure.
Right, okay.
Yeah, so I mean, we would have a situation where, with Patria, you would factor into this overall number your management fee, which we charge a flat 95 bips, direct expenses relating to the trust, and then you would have to look underneath the bonnet. Because we invest in funds, you would have to report all the management fees to the funds, you would have to report the carried interest, the performance fee to those funds, and that would end up being a big number. And at the same time, per the regulation, they had to assume a growth number of 5% at the top, even though our trust, as I mentioned at the start, on an annualised basis since inception has grown 11%. And what would happen is people would go into Hargreaves Lansdown and they would put, I'm going to invest £1,000 into Patria Private Equity Trust, and it would show them losing money. It was completely ludicrous. So that's the sort of issue that we had, and hopefully some of these cost disclosure discussions can get to the right place, and common sense can prevail. And I would echo what Andrew said at the outset. You should be looking at net returns here for these trusts and private equity more generally.
Yeah, if I'm allowed to chip in there,
well, I was going to say, but basically, it's one of the things that I'd be frustrated is that I can't buy Oakley at the moment because it's I couldn't because it was on the specialist funds market. So you've changed that, because this is the question here. So saying there's somebody here who's finding it hard to buy it. So what have you done that's different?
We were in the specialist funds segment. Yeah, we didn't, when we moved off AIM, we didn't qualify for the main market. We now do. We as of 2 weeks ago entered the main market. It sometimes takes some of the platforms time to adjust. They have to upload different documents to essentially take that designation off you that you are for expert investors only. And there were some platforms that wouldn't allow trading at all in us as a result of that. So we now main list, and hopefully as of next Wednesday we'll enter the FTSE 250, which hopefully should ease that trading. I mean, to kind of add my 10 pence worth to the discount debate. I mean, firstly, I would say that this isn't a PE. We can come up with reasons why listed PE is currently trading at discount. I mean, there are just structural reasons at the moment. I mean, investment trusts, what are there? 270 odd investment trusts, 250 of them are trading at a discount. The average discount they're trading at is 15%, and that's across kind of public equity, private equity, infrastructure, real estate, you name it. So, and I would argue it's right across small, medium-sized operating businesses. At the moment, there is a structural reasons why companies are being undervalued here in the UK, and it's down to 22 billion of outflows every year for the last 3 years. It's down to the lowest percentage of UK listed investment in UK pension funds. But I mean, you'll know the numbers better than me, James, but we're down to kind of very low single digit percentages now, you know, where we would have been half, you know, kind of half the pensions back kind of 20 years ago. Then there's the cost disclosure point. There's reasons why basically a wealth manager thinks, I'm not going to buy a listed PE firm. The last thing I want to do is have to justify this cost line that's going to appear in the statement. That you know, I'm going to get, you know, Mrs. Meekins ring me up saying, why am I paying £2,000 to OCI this year? Like, you're not. It's no different to the operating cost of Vodafone, but you don't see the operating cost line of Vodafone per share in your statement. So there are big things that hinder anyone wanting to invest, particularly if you're a wealth manager. IFAs will not speak to us, but there is hopefully a mood music changing. The FCA is becoming much more amenable, easier to work with. They are, you know, there is obviously an ongoing movement to try and change the cost disclosure rules. I think ultimately performance will out. If we continue to perform, if people take the advice of Andrew and Alan that said, don't forget about the discount. What's going to drive your share price is asset growth. That is the number one single biggest driver of performance. We track at least our NAV growth. You see the discount, you know, close and widen. Now that may be the cherry on the top, that it ultimately, as we get bigger, more liquid, and we perform despite the environment we're in, and yes, we produce even more. All the secondaries has come and eat this market up. We've always seen them come and take Apax. That was a big secondary buyer who are like, I can buy a set of positions here in funds at a deeper discount than they can buy in the market. And so you're going to see companies come off the market, there's going to be less and less supply, and that is ultimately going to change the rating, or, you know, the sector will eventually vanish.
Yeah, you've touched on the Apax question, which was it done here? I mean, the other two, do you have a view on consolidation within the sector, M&A, because we are seeing it in lots of other bits and pieces of the investment companies market? Do you think Apax is the sign of more to come, or do you think this is a one-off thing? Go, Andrew.
I don't have a particularly strong view. I mean, people have been talking about consolidation for an awfully long time. Not that much has happened. So we'll wait and see. I think Apax was a bit of a unique situation. You know, it's a lot of it's owned by the partners of Apax, as I understand it, and the vehicle that's taking it on has got quite a crossover. So, yeah.
We've had a lot of approaches from secondary funds wanting to do the same thing. Yeah. That's the sheer weight of secondary buying versus the mispricing of the public market.
Is there any benefit to being bigger, do you think, Alan?
I think there is. No, there definitely is, but it's a question of how much benefit. I mean, if you're 3i, you're however many billion they are these days, I mean, that's a huge benefit because of the liquidity of stock, and institutions will have confidence to hold your stock because they know they can get out when they want, and that's the big benefit. One of the big benefits of listed PE is that you're bringing liquidity to an illiquid asset class. So what you get to that sort of extreme end, it's a huge benefit, and obviously there's a benefit of scale on costs, etc. But there's no real, to the way that I see it, there's no huge correlation between the size of the listed PE trusts that are there, excluding 3i, and their discount, really. But I think, you know, undoubtedly scale is helpful. But yeah, it's not definitive.
For what it's worth, I keep saying avoid 3i because it's a single stock bet, which is a very dangerous thing. But there we go. But
if you want exposure to action as well, James, you can invest in PPET, you know. So there's my sales pitch.
There's lots. The government's trying to do lots of things to try and encourage pension funds, individuals to invest more in private assets. One of the things they're doing is this Pisces initiative, where you let you sort of trade things as though they were listed. Has anybody got a view on whether that's a good idea or not?
I mean, I'm not going to comment specifically on any one particular move. I mean, on one side of things, because I think we should be supportive of any way in which we're enabling people to invest in private equity. It is a growing part of the economy. 96% of companies, with turnover over 100 million in Europe are private, and investors aren't getting access to that. And in the meantime, the public, listed market is shrinking. 75% less companies on the market than there were in the 1960s, and the numbers, kind of falling every year. And so, allowing people to participate in the businesses and the economy in which they, around the world, I think is important. And PE is clearly one of the more interesting, kind of assets they should be getting access to. So, completely support that. I think that the challenge is, or the disappointment is, they already have the stock market. This is already a method in which, companies should be listing, thriving. You should be making, that market sing better, make the regulations and the access to it improve, such that we can see, encourage more inflows, encourage more UK pension investment, if not global pension investment in this, because that market, it exists, and it exists, for a very good reason. The idea that the reason why some of these other, whether there's all kinds of LTAFs and CTAFs, BIC scheme, and there's talk of, private equity, crypto, all great. But the one thing that they're all going to be challenged by is liquidity and getting enough people to participate in them to make them work. And so we've kind of, why not fix the one platform you've already got rather than trying to come up with other ones?
Yeah, I've written something this morning about this thing with the pensions bill, where they left listed investment companies out of the range of things that you can invest in as a pension fund to satisfy your private equity asset exposure, which is just daft, but there we are. And the AIC is fighting that battle. If you've got a strong view, please do write to the government and tell them. We've covered a lot of ground. I'm conscious of time. If we just sort of go around the three of you, why do you think now is a good time to be investing in private equity? I mean, we know this one. But this is not what we're trying to do. It's like we're not trying to make you buy it. But if you were just completely dispassionate, what was the attraction at the moment? Do you want to start, Alan?
Yeah, I mean, I think I'll give it a good go. I think the point in the cycle is quite interesting. Private equity tends to do a lot of its best transactions in these sorts of periods because entry pricing is more reasonable. You're typically coming in at cyclical low, and we've seen that in the back of the GFC, on the back of .com. That you tend to get better vintages at times of turbulence. Look, and specific to the PE trusts at the moment, the discounts are, pretty wide relative to the longer term, and so really it's only the start of COVID. And in the GFC, when we've seen discounts at these levels, at the levels that we've seen the last 2.5, 3 years. So there's a margin of safety when you're coming into a PE trust as well. And we've talked about the secondary market being at a much narrower discount on average than listed PE. Look, more broadly, let the other guys have a crack at this. I don't want to use up all the points, but according to Bain, there are 30,000 companies that are PE backed globally now. It's a big part of the global economy. If you have zero exposure to that, you're definitely missing out. Companies are staying private for longer. Private equity has diversification benefits vis-a-vis listed equity. The returns over the long term are strong. It's much more, and let's say a lot of the naysayers say it's just levered listed equity. It's much more than that. The key differentiator to me, just to conclude, is the governance model of PE. Majority control, significant minority holdings, the ability to influence, the ability to change fate, to change businesses, make them change faster. The PE firms of today are more than financial engineers. They create real value, they're sector specialists, and they take advantage of this governance model. So yeah, buy PE, that's my message.
Brilliant, thank you. Go on, Andrew.
I think Alan covered most of the things there, and I violently agree with him. I think this should be a good vintage year. I think the discounts are attractive, the yields are attractive. But I think the key for me is, if you look at things recently, the listed markets have outperformed private equity, okay, over the short term. But look over the very long term. The outperformance of private equity versus the listed markets is huge over the last 30 years. Unless you think things have completely changed, it will revert. And I strongly believe private equity will outperform over the long run. And it just gives exposure to super exciting companies that you just cannot get exposure to in the listed markets. One of our recent kind of sales to try and bring that to life a bit, we invested in a company called Dotmatics back in 2017. So this is a UK company. It was established back in 2005 by two scientists who come out of Merck, and they established a software company to allow R&D scientists to collaborate between and within labs. And we invested in that company. It was very clear that they were a market leader. They had great blue chip customers, but it was a founder-led organization, like we've been talking about all along. And they knew they needed help to professionalize it and get it ready for a sale to trade. We invested in that company alongside Scottish Equity Partners, a software specialist. And at the time, it was valued at about 60 million pounds. We then sold 88% of our stake in 2021 to Insightful Science, another private equity backed company. They rebranded Dotmatics. And then most recently, the remaining stake sold on 1st of July this year for 5.1 billion to Siemens. And the reason that Siemens paid 5 billion for it is that will be the cornerstone of their AI strategy for life sciences. Those types of businesses just aren't available on the public market, or by the time they are, you're getting in when the huge amount of the growth is gone. If you can get in early, the returns are great. Our returns on that investment, 8.4 times cost, 79% IRR.
Yeah, very compelling. Stephen?
This is going to overlap, but I'm gonna go for it anyway. I mean, I'm going to give you three reasons, and Alan and Andrew have already articulated these well. But for my own peace of mind, there are three reasons. One is, if your portfolio, and Alan made this point, doesn't include this, it's more of a balanced portfolio approach, you are missing out on two things. It's now a growing size. I think Andrew mentioned, or Alan mentioned, 30,000 backed companies. I mean, the BVCA, the kind of body that represents private assets here in the UK, I think say something like 20% of UK's GDP is as a result of UK privately backed companies. So it's a big section of an economy that you are not getting exposure to if you're not exposed to PE. And then, and more importantly, it's the nature of the companies that are typically backed by PE. And I know we are using a very broad term in private equity, because we said this goes all the way from C to kind of mega cap. But typically, as hopefully we've relayed to people that are listening today, these are new economy, growth, digital, disruptive businesses, as Andrew's giving you a great example of. There is a bunch of sectors which, typically PE backed long before they become established public equity sectors. Healthcare didn't exist in the public market 10, 15 years ago, but it did in PE. Education, a lot of backing now in private equity. There isn't much within the public. AI, there's one or two companies you can back with AI exposure. In private equity, there's a lot more. My second point is one that Alan made. It's the proactive nature of the ownership. This is not passive investment. Even the most active investor in the public equity market is completely passive. To manage and to invest in, we've got 30 companies currently. There's a team of 60, backed by a team of 20 portfolio team, backed by another 150 people, providing the kind of legal, accounting, kind of financial support. We control our destiny to some extent as a result of the kind of control investments, majority investments we have. And then finally, and the guys have both made it, performance. it doesn't matter on what time scale you look at. You know, the 5-year CAGR of the FTSE All Share is 6%. MSCI, if you want to be generous, 12, 13%. The global PE index is 14. If you want a listed PE proxy, you know, OCI CAGR over 15 years is 18%. Not only does PE over most timescales outperform public equity, it's a chunk of the market you have to be exposed to if you want a balanced portfolio. And listed PE is a very good proxy to that global PE market.
Brilliant. Thank you very much, all. That's been really good. Hopefully we've convinced some of you. We should wrap up with disclaimers and things. Let's move this here. Very important disclaimers. Remember that we're not trying to make you buy these companies, but never, we are trying to make you think. That's the point of the whole exercise. So thank you very much again to my panelists. Really interesting show. If you've got any more questions, just let me know. Email me. Just to flag, on Monday we are launching our awards. There is a category there for best alternative assets for growth and income. So if there may be some of these people nominated, we never know. We shall see on Monday. And because we want you to vote, if you are closest to predicting who the winners will be in each category, you could be in the chance of winning £5,000. So do look out for that on Monday. You'll be emailed about it over the weekend as well. I will be back next week talking to Andrew McHattie, who's going to be running through what happened over the course of August, and then also the manager of Ashoka India. So thank you very much for everybody listening today, and have a good weekend.